Welcome back to Pro News, your go-to source for the latest trends and analysis in the global financial markets. Today, let's delve into the intriguing journey of the dollar index this November. The month started with the dollar reaching a local peak on the 1st, but what followed was quite the sell-off, reaching its climax 2 weeks later. Remember the weak inflation report released on the 14th of November? That sent the dollar spiraling. It took exactly a week for the dollar's decline to taper off. It wasn't until Tuesday, the 21st of November, that the dollar index found its footing and began an upward correction. In just 3 weeks, the dollar index shed 3.6% of its value, effectively halving the gains it had made since the end of July. It was a classic case of a slow climb followed by a rapid descent. Interestingly, this move is quite atypical for the dollar. Currently, the dollar index is flirting with its 200-day moving average. Breaking below this level could signal a prolonged downtrend. However, if it manages to hold above, it could trigger a new round of buying. Federal Reserve officials have been cautiously hinting that rate hikes aren't off the table yet, and that it's premature to talk about rate cuts. But here's the catch. The market seems skeptical of the Fed's stance. It's already pricing in a rate cut between March and June and sees little possibility of further rate increases. Now we turn to gold, which has had quite an eventful week. Once again, gold tested the $2,000 per ounce barrier. This isn't the first time. We've seen similar attempts just under a month ago, and even earlier this year, as well as in 2021 and 2022. Each time gold crossed the psychologically significant mark, it was followed by a prolonged correction, almost creating an aura of invincibility around this level. Interestingly, each correction has been shallower than the last. From a technical standpoint, gold approached this crucial $2,000 mark in a state of short-term overbought conditions, which tends to favor the sellers. On the fundamental side, there's a renewed interest in bonds in global financial markets. US and European equity indices are hitting multi-month highs, pulling investor attention and capital away from the safe haven, non-income generating metal. However, for the bulls, there's a glimmer of hope. We're seeing a golden cross where the 50-day moving average surpasses the 200-day, a signal that often draws new buyers to the asset. Given the current scenario, it might seem a bit safer to bet on a decline, taking the bear side. But as always, the markets are full of surprises. Now for the US stock market's latest moves. Despite a shortened holiday week, the market showed resilience. It dipped slightly, but maintained its overall upward trajectory. The Nasdaq100 in particular spent a notable amount of time above the 16,000 mark last week, trading at its highest level since January 2022. Remarkably, it's now less than 4% below its all-time peak. What's intriguing here is the market's apparent disregard for the current interest rates, which are at a 22-year high. Typically, these rates are viewed as a significant headwind for high-growth companies. Yet, the market's recent performance almost suggests those rates are a non-factor. Last week, the oil markets were abuzz with a flurry of activity. U.S. crude oil inventories continued their upward trend, and reports indicated a slight uptick in OPEC supplies. Complicating matters is the looming concern over a global economic slowdown, particularly impacting traditional energy carriers. Amidst these developments, OPEC made an unexpected move by rescheduling its next meeting from November 26th to the 30th. This delay hints at some intense internal dynamics within the cartel. There's market speculation that Saudi Arabia is advocating for deeper quota cuts in an effort to counteract a significant price drop, over 20% since its late September peak. Historically, they have shown unity in efforts to elevate prices, but it's important to remember the past scenarios. Back in late 2014 and early 2020, Saudi Arabia shifted its strategy from balancing the market to prioritizing market share. In both instances, this led to a dramatic plunge in prices, dipping below $30 and rendering oil production unprofitable for many. These historical precedents could offer insight into the potential outcomes of the current situation. The crypto market recently experienced a whirlwind of volatility. largely due to the unfolding drama around Binance and its CEO. Despite these turbulent events, the primary cryptocurrency, Bitcoin, managed to stay within its established trading corridor. This corridor is characterized by a pattern of higher lows and higher highs, a trend that has remained steady even amidst market upheavals. Interestingly, this uneven trading pattern in Bitcoin provides some strategic advantages. It offers bulls the opportunity to take a breather, secure their profits, and reposition themselves. This pause in the action can create a conducive environment for potential further growth. As the crypto market navigates through these choppy waters, these developments could play a crucial role in shaping future trends. In the upcoming week, the markets are set to turn their attention to several key areas. One of the main focal points will be the decisions made by OPEC, which could significantly influence the oil markets. Additionally, the US property market and various European economic indicators are expected to draw interest. For the United States, keep an eye out for the primary home sales estimates coming out on Monday, followed by house price data on Tuesday. These figures could provide insights into the current state of the US housing market. Also noteworthy is the New Zealand's rate decision, scheduled for Wednesday. This announcement could impact not just New Zealand's economic landscape, but also have broader implications for the Asia-Pacific region. In Europe, particularly in Germany, the inflation data for November will be released on the same day. This data is crucial for understanding inflationary pressures in one of Europe's largest economies. As we move into December, the first day of the month brings us the Canadian employment figures and the ISM manufacturing data from the US. Both of these are significant indicators of economic health in their respective countries. Stay tuned to Pro News for more insights and updates on the ever-evolving world of markets.